Hello and welcome to episode 17 of the Ask About Wealth podcast. As regular listeners know, our promise is to bring you a cross-section of people in interview format. Some of those people are entrepreneurs and we like to hear their stories of how they became entrepreneurs. And then the other side, we wanted to bring you perhaps fund management groups that are not on the high street, as it were, that are somewhat hidden from view from the high street perspective. So in that context, I'm delighted to welcome today Karl Rogers, who's Chief Investment Officer of Elkstone. Karl, thanks for coming along today.
Well, thank you for having me. A pleasure to be here.
Karl, we'll jump straight into it if you don't mind. On your website, for example, you describe private markets, and you talk about private markets being the missing link in many people's portfolios. Can you tell me what you mean by private markets, number one? And secondly, is there a percentage, do you think, of people's portfolios that should be allocated to such markets?
Yeah, absolutely. Private markets is incredibly important for us at Elkstone. Private markets are investments that you're able to make in private, for example, companies versus public companies. So private investments that aren't available for public investment into. So the likes of investing into a private company instead of a public company, providing a loan to a private company versus a public company, or going out and making an investment into a real estate building, as an example, that the public is not able to invest into. In terms of where does it fit into a portfolio and how, I'll answer that by speaking to the average allocations that people are investing across the different investor groups who are involved in private markets. So private market investing really started out being invested in by the institutional investors, the likes of your pension funds and your endowment funds. Usually they are capped at anywhere between 5 to 20%. And when I speak to the chief investment officers of pension funds, what they tell me is they are at the max. They would love to do more, but they're just not able to lock up money for any kind of medium to long term beyond that 5 or 20% mark. In terms of, let's call it the individuals, the likes of high net worth, the individuals, family offices were really the next investor segment to move in there. And what we're seeing is broad report citing that family offices now hold about 50%, so that's half of their portfolio in private markets, which is, of course, a pretty reasonable sum.
Very good. And I've heard that phrase, that name, family office, used over the years, and frankly used to describe different types of organisations. When you say private or family office there, what do you mean by family office? Yeah,
family office is a term that gets used pretty broadly and for different reasons, but family office would tend to mean a single family office. So a single family office is a company that's set up to look after the wealth of an individual or a family. And that would look after all areas from wealth management, investment management, legal, tax, estate planning, any charity work that they do, and so on. So all those family offices would have a client of one, either the individual or the family. The other one that you'd come across is family office, shortened from a multi-family office. And that would be more of an investment or a service provider firm that would look after a number of underlying families across those different services.
Okay. And just to make sure I understood you correctly, broadly speaking, in the kind of fund management space, as it were, the fund managers are allocating somewhere between 5 and 20% to private markets in that, and then in the family office space, they seem to be allocating around 50%.
So yeah, the firms that are responsible for investing the money behind a pension or an endowment pot, they are bound to about 5 to 20%, and they are investing the maximum.
They're legally bound,
and they are investing the maximum that they can due to the benefits of private markets. Whereas family offices, which are individuals and are not bound to those constraints, we're seeing that they're investing roughly 50% of their total portfolio.
Okay. your investment offering, as what I can see, seems to break down into three categories. Those categories being real estate, venture, and wealth management. Can you tell us a little bit about those three and what that actually means?
Yeah, so I'll give you the internal summary across each of them, but then most importantly, the client view and what that actually means from a service perspective. So venture investing is investing into very early stage private companies that aren't publicly available. So anywhere from the idea stage to the point where they need funding to get the initial prototype or the minimum viable product ready, and then really look to grow their client base, increase revenue, and really scale on from there. On the real estate side, that is, of course, the buildings. Where we operate primarily is on the planning side and the development side. So real estate can be broken down into three different life cycles. You have your planning risk, which is where you go and see a piece of land that you want to buy that does not have planning permission, and then you take it through the planning process. If you were successful with the planning process, you now have planning for that piece of land, which increases the value of that land. The development stage of the life cycle is then you then go and physically build the building that you've received planning for. And then at the end of the development, you have a physical asset that can then start to be rented out or leased out, which then becomes an income generating asset, which then falls into the final stage of the life cycle, which is asset management. So Elkstone would primarily focus on the first two stages of the life cycle.
Okay. And then the wealth management?
Yeah, and then wealth management is where we provide cash management services primarily to corporates. That's really plugging our infrastructure that is across Europe and globally to Irish corporates and individuals to build out a custom portfolio for the excess cash reserves. The wealth management service is where we go and build out custom portfolios for individuals right across all asset classes, so public markets and private markets, across equities, credit, real assets, as well as uncorrelated strategies. And then the investment management service within the wealth management arm is where we have built out our internal public multi-asset portfolio and private multi-asset portfolio, where investors are able to invest into those portfolios.
So this is effectively a model portfolio that you and others within Elkstone have come up with as ideal, as it were, for a certain type of client. And then breaking down into public being broadly the securities markets, I presume, and the stock markets, and then the private being what you described as the private. How did you come up with whatever asset split you have in those?
Yeah, that's a good question, and it all comes back down to the philosophy. So, I've been on the trading floors before. I've been a hedge fund manager out in New York, and we've gained a lot of experience from being on those floors to really inform the investment philosophy that we have within Elkstone. I'll give you a little bit of insight into some of them, but one is it's impossible to do macro forecasts. So we don't pay any attention to macro forecasts, and we don't try to do any price prediction. The markets are far too complicated, and therefore we don't put any weighting on that. We also believe that inefficiencies exist within markets, but there's different inefficiencies across the different markets, and therefore you have to approach those markets differently. So, for example, the approach that we take in equity markets, public equity markets, could be very different to the approach that we take in public commodity markets, as an example. So really, it's understanding how to go about navigating those. The third philosophy that's core for us is really expanding our investment universe as wide as possible, because that increases the numbers of different strategies and markets that we have available in order to build what we believe is an optimal portfolio. So our public multi-asset portfolio, of course, looks at and invests in the likes of public equities and public bond markets that everybody would be very used to. But we also open up the public alternatives world as well, the likes of gold and commodities and famous strategies like trend following within the commodity traded advisor space to make sure that we're able to build a really robust portfolio that can navigate through an entire market cycle. So really complementing out a 60-40 portfolio with other return streams that can bring in a similar level, but importantly, they get there in a different way, adding diversification and reducing potential losses during times of market stress like 2022 and so on.
Right. And you must have to rebalance those portfolios, I suppose, as different assets grow or fall in value. How do you deal with that?
Yeah, portfolio construction is always an important part of building investments. And generally what you would see within the industry is two different areas. So there would be what's called SAA, so strategic asset allocation. And that would really be long-term across all the asset classes. What's the range that we should have in the private market world, in private equity versus private credit versus infrastructure, as an example. And then the other type of allocation you have is tactical asset allocation, and that's more short-term focus. So to give an example, we have strategic asset allocation within our private multi-asset portfolio of between 40 to 60% of private equity. And then tactical, we're saying in the short term, where within that range do we want to be and why? And that's really a function of looking at the macro conditions, where are interest rates, what's inflation doing, what's the outlook for markets moving forward. I only read yesterday AQR's most recent capital markets assumption, and as an example, they're expecting 3.5% annualized over the next 10 years from a public equity and public bond portfolio. So you need to take into consideration expected returns where markets have gone to.
And that would be considerably lower, wouldn't it, than historical returns over 10 years?
Absolutely. But in markets and investing and trading, recency bias is always holds within market. So absolutely, when we look at the last 10 years, those returns would be low double digits from an annualized perspective. But it's worth highlighting that the last decade of returns is an outlier when it comes down to the decades. So if you look back to something like 1923, the average equity market return is actually 8.02% in the S&P 500. Whereas we've witnessed double digits over the last 10 years. It does naturally mean that if we're to go back to that long-term average, then it is going to be underperforming. And JP Morgan actually came out with a very interesting statistic. When PE values are at the levels that they currently are in equity markets, the next 10 years in terms of return performance has tended to be anywhere between -2% and +2% annualized. And that is reconciling with the likes of Goldman's 3% annualized expectation, AQR's most recent 3.5% annualized. So that lower expected return outlook from traditional markets is, again, one of the reasons why private markets are the missing link.
Yes. Okay. One of the other things you said, or was on your website, is to do with, I think I read something like, you're unconstrained by the limitations of mainstream wealth management platforms. And I presume one of the meaning of that is, I think you've answered a bit of that by saying that mainstream platforms, for example, where private markets are concerned, have a limit to how much they can expose to those markets. Is that what you mean by that statement, and what else might mean?
No, not quite. I would say, I touched on it previously, but by way of the core investment philosophy of making sure that we're working with as wide of an investment universe as possible. And so very often, unfortunately, the way that it works within the industry is a lot of wealth or asset managers would only be building portfolios that are available on their current platform. So it was really important for us when we were setting up the infrastructure internally within Elkstone that we wanted to be agnostic to an individual platform or set of investments, and therefore worked very hard to find and bring in a broker with open architecture where we were able to add returns and funds across multiple different asset classes, and that really allowed us to bring in investment options across public alternatives, the likes of gold, the likes of commodities, the likes of those commodity trade advisors, because they play an incredibly crucial role within our public multi-asset portfolio. And many, whether it be private banks or wealth managers, their platform tends to be more narrow in scope and therefore don't incorporate the full range of strategies and options that are available. Correct.
Yeah, okay. And you can not answer this question if you don't want to, but you were saying there about the crystal ball gazers, if you like, looking at 3 to 3.5% a year return from the kind of public portfolio in the next decade.
Yeah.
What, if at all, could you predict what the same return will be in the? Might you expect in the private market? And I know that's not quite a fair question because they're two completely different things. But
yeah, so okay. I think the best way to answer this is looking over the medium to long term, and private market investing is very much set up for that. Traditionally, private market investing would have been done so through these 10-year closed-end funds. So when you make an investment into a private equity fund, as an example, you are investing for 10 years. You're not investing for just the next 6 months or the next 12 months. You're investing for the next full market cycle.
Right.
And that's the way that we do approach return expectations. So when we look at the public markets as an example, what are we actually trying to achieve? Anywhere between 5 to 7% annualized. Why is that? Because when you look over a much longer time frame, not just the last 10 years, which has been an outlier, and our own portfolios have performed very well during that same 10-year period, the return expectation across public markets is falling between that 5 to 7%. Private markets, one of the real drivers in terms of why capital flows are moving there is because historically private markets have earned a return premium above beyond their public market peers. So if we look at some of the data as an example, within the equity world, private equity has brought in anywhere between 3.5% to 5% above the public market peers during the same time frame. A little bit lower on the credit side, that's closer to 2.5% on the credit side, and similar across real assets like real estate and infrastructure. So when we built out our private multi-asset portfolio, we built that with a target return range over the next 10 years to be between 8 to 10% annualized versus our public multi-asset, which is 5 to 7% annualized.
Okay, very good. ESG is something that pops up its head around investment, environmental, social governance. I think that's what that ESG stands for. And I see, Karl, you're from your LinkedIn profile, just focus on you personally for a moment, that you're a special advisor to the ESG Foundation. So can you tell me a little bit about what is that foundation, what are its objectives, and what does special advisor to such a foundation do?
Yeah, so the ESG Foundation was originally set up to try to bring the best practices and policies and have corporates be able to implement those. So ESG is an incredibly wide topic and means very different things to very different people. So the goal actually of the ESG Foundation, for example, wouldn't be how ESG comes into my mind, our frame from an investment perspective, because as an investment firm, we're not necessarily looking for to deliver what's best practices for corporates. Is how do we implement ESG in terms of investment processes and through the investment policy statement itself. And that can vary whether you're an asset manager or a wealth manager. So in terms of our venture and real estate business, of course, ESG plays an incredibly important role, and both in different areas. Certainly, the environment plays a very big role within the real estate business. And S, the social aspect, will play a very big role in, of course, real estate as well as the venture side of the house as well. When it comes down to wealth management and private clients and individuals, it is a very personal area, and therefore you cannot build a one model portfolio and expect it to fit, because if you get into a room with 10 different people, they might care about 10 different things across E, S, and G, and therefore the one portfolio won't suit everybody. So in the wealth management world, it's all about providing education around what ESG is and how difficult it actually can be to execute on that within an investment landscape.
Yeah, and therefore, in terms of the individual investor's portfolio, you're gauging how important ESG is to that individual investor, to help them find a portfolio or a range of portfolios that match their view.
Yeah, absolutely. Like any wealth manager or investment advisor, you build a custom portfolio. What does that mean? It means that you're taking into consideration areas like, what are the investment goals? What is the risk profile? And what are the individual preferences? And ESG preferences would certainly fall under that part of the analysis in terms of an investor's individual preferences.
And is that foundation, Karl, is that an Irish foundation? No. Is it a EU foundation?
It's based over in the UK.
Okay.
Yeah.
Okay.
So I would have also come back to the earlier question. As an example, I would have helped introduce Trinity College Dublin into the foundation and have some of the academics liaise with the firm, as well as open up some internships for jobs within the ESG.
You're reading my mind here, because my next question for you was indeed to go back and focus on you for a moment. And I see also that you sit on the faculty of Trinity College MSc Finance programme. What does that entail, Karl?
Yeah, so the MSc in Finance is one that is the master's program that I actually did a number of years ago. I won't say which year anymore, but it's good to be back. So I spoke with the director of the program recently. Of course, Elkstone being kind of private market specialist, I was quite curious to see from an educational perspective, where do private markets actually fall within the curriculum of the Masters in Finance program these days? Especially considering family offices have about 50% of the portfolio, it certainly needs to be highlighted. So I took a role with them as adjudicant professor. I've built and will be delivering the private equity module for the master's program there. So that will touch on private equity by way of buyout. It will also touch on venture capital. And then there's going to be a small sliver on private credit as well. So private credit is an asset class that was actually born from private equity, but has since grown legs and become its own asset class, to the point where institutional investors actually have roughly 10% of their portfolio within private credit as an asset class. So it's delivering that and making sure that it is getting airtime for the Masters in Finance program within Trinity.
So the future people who are exiting Trinity with their Masters will know something about private equity and private debt, which their predecessors may not have known.
Yeah, that's certainly the hope.
Yeah, good. I had a client of mine years ago who told me he had 22 years of formal education. He didn't have 1 hour to teach him about money, which was, so it's good to hear that you're giving back a bit, and that these people will graduate with some knowledge of these new markets, newish markets. I know they're not new, but they're perhaps new to our listeners.
New to certain investor segments.
As Chief Investment Officer of Elkstone, and I understand you're leader of the investment committee there, what does a normal day for Karl look like? How do you spend your day? How do you split between those slightly different roles, maybe?
Yeah, every day is different. I have one leg on the wealth management side, and of course working with clients and building up their portfolios and making sure that we get lots of meetings and education is provided. And then the other leg is on the asset management side, which is the building out of the portfolios. Right now, there's a big focus in building out our public market research platform as well as building out our private market research platform. So that's taking up a lot of my time right now. But ask me the same question again in 1 month, 2 months, 3 months time, and it's going to be quite different. But really, it's making sure that the processes are there across the entire investment journey. That's everything from building out of the investment philosophy to building out the research function to building out the investment and manager selection function, and then making sure that the IC is running smoothly with proper governance and proper ongoing investment research and analysis is being taken.
Yeah. So there's a lot of time in that, Karl, and a lot of cost in that. Looking at the cost side, how do your clients pay you for the various services you provide?
Yeah, so from the client view, Elkstone has 4 different services. So one of them is the cash management service. So that is 25 basis points, or 1/4% on the portfolio that we manage. The investment management service, so that public multi-asset and or private multi-asset portfolio, is 75 basis points on the money that's managed. The wealth management service is 25 basis points on the portfolio that gets managed. And then the self-service digital platform, that's free to join, and that's essentially a pay-to-play model. So for example, traditionally with our venture investments there, clients would have been able to access with no management fee. It's just a 20% performance fee upon successful liquidation of the underlying investment. So very, very client friendly.
Okay, well, good. And ideal clients in those spaces, how do you define them? Do you define them with the amount of money they might have to allocate? Or what are your ideal clients in those 4 categories you've mentioned?
I think there's a small misconception with Elkstone out in the industry in that, you need to have 50 million euro to be an Elkstone client. That's absolutely not the case. The industry at large refers to an investor or a client segment as private wealth. So maybe another way to describe that would be mass affluent professional services all the way up to high net worth, ultra high net worth. So certainly between our portfolios, we're able to cater to a little bit of everybody. As an example, within the investment management service, those investments of those portfolios are at 500,000, whereas the self-serve digital platform to invest into kind of the individual Irish startups, that's 15,000 on a per company basis.
Okay, so there's a fairly broad
range. Yeah, there's a big range. Something for everybody.
I know you told me earlier before we started recording that the investment management service was a relatively new offering. So how does a customer go about talking to you about that? And I mean, can they do that no fee, as it were? Is it something that you will take a meeting with somebody to tell them about it without?
Absolutely. I'll use a line that Niall McAvoy, one of our venture partners, says very frequently, and it's we want to make sure that Elkstone is approachable. We're out there in the market, but make sure that we're approachable as well. So absolutely, via our website, there's certainly inquiry forms. Reach out to myself or anybody from Elkstone via LinkedIn. More than happy to spend time to give a rundown of all of our different services and portfolios and see what the right fit for you is.
Okay. I think to be commended, one of the things, and you had told me that before we started recording, I really do like the idea of performance-only fees. I think that's a super idea. I mean, it's something that I told you before we started recording. I tried to get certain brokers to do in Dublin for many years ago and was laughed at, but it does mean, it does mean a complete alignment of goal, doesn't it? And I think that's important. Can I also ask you about, do the founders, directors, managers of the business, your business, do you guys get involved in the investment side as well, with your own money as well as clients' money?
Yeah, really important question. And the answer is yes, we put our own skin in the game. So traditionally, we've always made an investment into each of the startups that we bring through that kind of self-serve club. Same thing on the real estate side, and it goes beyond the founders as well. For example, I myself have investments into some of the direct startups. I've invested into Elkstone's first venture fund and plan on doing so again for the successor fund as well. Right. So absolutely, not only the very senior people, but we make sure that everybody within Elkstone actually has access and the ability to be able to make investments into the same investments that we bring. Very good.
Clients. I mean, I think you've hit on skin in the game is the important thing. I mean, I certainly think if far too often I've seen fund managers in my long career willing to invest and risk my money but not theirs, so that's good to hear.
It comes back to the alignment point that you just brought up.
It does, it absolutely does, and it shows, I suppose, confidence. If you're going to put your own money in it, as a potential investor, I'm more confident than I would be if you were only willing to risk my money.
Absolutely.
Karl, I've come to the end of my list of questions. Is there anything we haven't covered that you'd like to talk about?
Just to reiterate that we're an open door policy. I think in order to be the private market specialist, you also have to be the leader in private market education. And for anybody that wants to learn more about private markets, feel free to ping us.
That's good. Thanks, because I did see something. Aren't you doing an educational webinar soon, or has that been done?
No, that's next week. I think that's the 6th of February with myself and one of the other managing directors within the firm. And there's been great appetite and uptake on the webinar so far.
And is that a free to join thing?
Absolutely, yeah, absolutely. Okay. Absolutely.
Well, it only remains for me to thank you, Karl, for coming in today. I'm delighted that you did, and maybe in the future we might have you back again, because I'm sure often after these things we get a whole bunch of questions in DMs that we should have asked that I didn't think of asking. But for now, thank you very much, Karl, for joining us today.
It was a pleasure. Thank you.